Well, the markets are looking to get back on a winning streak. Stocks have dropped for the past 4 sessions. Financials have been under pressure in particular. Some say the recovery might be stalling out. Our next guest, though, is still bullish on stocks and loving China as an investment. We want to welcome to the show Barton Biggs, the co-founder of Traxys Partners, which manages $1.4 billion. He's also the author of A Hedge Fund Tale, his most recent book, among many other publications you've come out in the past few years you're so well known for. Barton, welcome to the show.
Thanks, Margaret. Nice to be here.
Nice to talk to you. We've had 5 weeks of a down market. Are you finding opportunities?
Yeah, unfortunately, I was positioned for opportunities 5 weeks ago, so I haven't necessarily enjoyed the decline. But yeah, I think if I thought stocks were attractive 5 weeks ago, I think they're more attractive now.
But one sector that you've said you don't find too attractive are the financials right now. You compared them recently to NASDAQ bubble era.
Well, yeah, I said that in the context that of the stocks of the sectors and stocks that I want to own, the financials are not in that category. But I'm not negative on the financials necessarily, and for this recovery to sustain itself, as I think it's going to, the financials are going to have to do better, and I think they will.
But the argument is made, financials are relatively cheap right now. Why not consider them? But is it the headline risk that makes them comparably less attractive to you, or is it worries about housing, worries about the broader economy?
Well, no, it's not worries about the broader economy. It's worries about housing, and it's worries. And I don't feel confident that I can really count on what the financials say their book value is, and we know how ephemeral book values have been, and we know how ephemeral earnings have been. And so if I saw a real improvement occurring in the price of existing single-family homes, that'd be a different story, because then I think we'd be looking at write-ups in terms of the financials earnings statements. But with home prices still falling, I'm concerned that we're going to be looking at write-downs.
Well, when you look at the opportunities, I know you had said that technology has been attractive to you. A big part of financial earnings for those technology companies comes from businesses spending on equipment. When you see firms start ratcheting down their expectations for GDP growth, does that start to make you question the technology health?
Yeah, it makes me question it, but the most recent surveys, and I just finished reading one that ISI just put out this morning, and a survey of a whole series of different corporations showed that capital spending expectations by corporate America are still very strong. And so I'm not worried that there's going to be an order downturn for the technology companies.
And within those technology companies you do like these days, they're not necessarily the new wave of stocks. They're not the LinkedIns of the world. They're more of the chip makers, the more traditional tech stacks.
No, the LinkedIns are beyond my powers of comprehension. But but the irony is that the new financials, that the companies that are doing the new things, I think are incredibly attractive and are terrific investments here too. I'm talking about Apple and Qualcomm and that whole group. But the old financials, the Ciscos and Intel and stocks like that, are incredibly cheap. And so you can almost buy them as big not almost, you can buy them as big capitalization value. They're way too cheap.
Mm-hmm. You know, in this most recent book we referenced in the introduction to you, I was reading it over the weekend, and you talk, A Hedge Fund Tale, you talk about the rise and fall of the hedge fund manager, Joe Hill. And in it, you set it up with the idea that in some ways he's symbolic of the rise and then the fall of an industry, of the hedge fund industry itself. You're a global macro guy. What do you think when you look at some of your competitors out there? Where is the hedge fund world?
Well, I don't think I wasn't forecasting the rise and fall of the hedge fund world. I was just saying that in the in the crisis of the financial panic in 2007, 2008, 2009, that there was a lot of death and destruction in the investment management business, and particularly in the hedge fund world. And incidentally, it's still going on. And so I'm just talking about I'm just trying to make the point that we're not in a secular bull market the way we were in the 1990s and the first part of the 2000s, where everybody but started, or most people that started a new hedge fund, everybody got rich and lived happily ever after. A lot of people got rich for a while and then really got crushed in what happened.
Too many Joe Hills. Too many people hanging out their shingles. But at the same time, we've seen giants like Stan Druckenmiller say, you know what, I'm gonna take a little bit more time off. I'm gonna not be as active in this industry as I once was. I mean, what do you think when you see that? Is it getting just so much more difficult to be placing macro bets in an environment like this one?
Yeah, this is a more difficult environment, but Druckenmiller is a great investor, and he won't have any trouble placing bets. And just recently, he made a terrific bet by being long the U.S. Treasury bond when nobody else was. So he didn't do it because he felt investment fatigue. I think he did it because he had other things he wanted to do with his life, and worked more in his golf game, and he was tired of interacting with clients, and he wanted a more peaceful life.
Not you, though.
Well, I mean, I think I have both, and I'm not as rich as Stan Druckenmiller. So.
Barton, I enjoy having you on the show. Looking forward to talking to you more ahead.